Thank you for joining me in this session. This is Friday, and in a few hours' time, it will be a weekend. So this is very precious time for you. I hope you will gain as much during this session. Basically, this is a e-text guide that was published by IRAS specifically for medical doctors. As you can see the title of this e-text guide. And for those who have been with us, you will realize that this e-text guide is not first time being published by IRAS. If you recall, back in 2018, if I could be very precise, it was sometime in October 2018 that IRAS started a very massive audit of doctors, all right, back in 2018. So they have been going around since 2018, auditing specific doctors on the setup and so on. Then about in 2020, they published one text guide also for doctors. But it was a very brief e-text guide, basically providing some basic information on how doctors should account for their income, whether it's under the corporate company or is it as an individual. And along the way, there were some cases in the Income Tax Board of Review, and there was also one case that went all the way to the High Court. One just concluded in May 2024 this year, and subsequently, IRAS then published this tax guide. Okay, so what we're going to do is basically focusing on the e-tax guide. Looking at what the purpose of the e-tax guide, why IRAS started this e-tax guide, which have earlier just giving you some background to this e-tax guide. Then we also look at what is tax avoidance under the Income Tax Act. A very big topic in recent years, not just for medical doctors, for all business entity. IRAS have been looking at how companies are structured, and therefore how whether this structure that the companies or businesses have set up fall under this what we call Section 33, which is basically a section in the Income Tax Act that deals with tax avoidance. All right. And then what's the IRAS approach when they look at tax avoiding cases? That they also have amended the law back in 2022 and make certain tax avoidance cases, if found to be involved in certain arrangement that falls under Section 33, there will be a surcharge, which I will talk about it later on. And we will also run through some case study in the tax guide, again, specifically targeting medical doctors. And what are some of the administrative procedure when you're audited? What are some of the things you could do when you're audited? And then we will finish off with some frequently asked questions. Hopefully, it will address most of the things you need to know. And should you require further clarification, like Valerie had mentioned, there is a tab or a button right on top as a Q&A. You can type a question there, and then at the end of my session, I will go through the Q&A with you and tackle some of the issues that you may have. Okay, so like I mentioned, this e-tax guide is not something new. There was already one that was issued back in 2020. And this is basically an upgraded version of the e-tax guide, which was published in September. In this e-tax guide, they actually expanded a lot more on the technical part of the law, right on Section 33. So I don't want to bore you today with all the technicality of Section 33. I will briefly run through it. What I will focus will be on some case study, so that you can understand what sort of corporate structure, what sort of setup that you have may infringe this Section 33 as a tax avoidance situation. And then maybe then you have to go back and review whether you need to restructure what you have now presently in terms of the setup that you have. So like I mentioned, basically IRAS have audited many doctors since 2018, and also there were 2 cases that has some ruling from the Income Tax Board of Review, and also one went to High Court. And with that, that's why IRAS came out with e-tax guide. And when they issue a e-tax guide, okay, just want to clarify, e-tax guide is not law, right? It's not law. I mean, court judges have also commented on it. Yeah, Singapore court for certain tax cases, it is made very clear that e-tax guide is not a law. All right, any law or any issue, only when they are decided by the court, then those are case law. E-tax guide itself is not. But I guess because IRAS have been successful in the 2 cases that they have, so based on the judgments from those 2 cases, they have more or less come up with some of the opinion from the Board of Review and also from the court, and therefore they come up with this e-tax guide. While it may not have any, like I mentioned, it's not really a law itself, but because of the 2 cases that they have put forward some case study to illustrate under what circumstances will you fall under tax avoidance. All right. So as you can see, IRAS have been auditing doctors since 2018. So they don't just audit doctors, they audit all kind of business, and every year they will have certain target group, and they do publish on the website. So if you are keen, you can actually go into IRAS website and go and look at what are some of the industry or business type of business that IRAS are focusing on. If you are aware, just a week or 2 weeks ago, IRAS have published in news media release to highlight some tax cases relating to the funeral industry. All right, because in the funeral industry, a lot of cash transactions are involved, so there's a lot of tax evasion or cases like that. Or through audits, they have recovered a lot of taxes from the funeral industry. So every year they target a certain group of people. But I think for medical doctors, that they have started since 2018. So this, and I would expect with the release of this e-tax guide, there would be another round, because as IRAS will told you, I really give you an e-tax guide, we tell you what you need to do, what you cannot do. So I would expect that there may be another round. Every time when they issue an e-tax guide on a particular industry, next step they will do is to go around and audit them to ensure that they comply with the e-tax guide. Right. So through e-tax guide, they want to highlight common errors and certain tax treatments. Right. So like I mentioned, for this particular guide is a focus on medical doctors how you structure your business, whether you structure a business in a way that fall under these tax avoidance rules. All right. So in the e-tax guide, they explain quite a fair bit on the Section 33. Right, like I mentioned, I'm not going to the technicality, more focusing on the case study so that you are fully aware what kind of structure, what kind of setup you have. Will you infringe this tax avoidance rule? Okay, so there are a lot of examples in there, about 6 of them. All right, so it covers a majority of cases. Some of the cases I myself have came across. But there may be some other set arrangement out there. That's why IRAS have been very cautious to say that not everything that are covered in the tax guide are exhaustive. It can be more out there, and they do look at those cases that are not highlighted in the e-tax guide. All right, so that means they're very wide. So in the e-tax guide, they're given 5 or 6 case studies. If there are more out there, they may also look at it and give a ruling on those setup. Okay, so basically, for this kind of issue, is not really an evasion cases. Evasion are more serious, where you really underdeclare income and don't pay taxes. So Section 33 talks about tax avoidance. Basically, certain arrangement that you have, and you're taking advantage of the tax law, and therefore you have certain tax savings which in the view of the IRAS, they are not legit lah. All right. Okay, so while we have this tax avoidance under Section 33, there's also under Section 33(7) that while you may satisfy certain criteria or factors in the avoidance, but if you can prove that your setup is being done for a certain commercial reason, so they can also waive this tax avoidance requirement, which is covered under Section 33(7). Okay, so very important is like I mentioned, we will look at the reason why you are in a particular kind of setup, and therefore it's important that you are aware what are the do's and don'ts. Okay, so in IRAS view, all right, in IRAS view, they look at the medical profession or the medical doctors. There are a lot of the work that you are doing is basically rely on you. All right, you are the key person to deliver the service, right? If you are a specialist for eye, you do surgery, you are the one doing it. You may be supported by nurses and other anesthesists and all that, but a lot of the work is personally done by you. So they view that kind of service that very much is your personal service, right? But just to highlight that there's no law to say that personal service also, cannot set up a company and things like that. I think it's also in the 2 cases that was decided in the court. They didn't rule out that you cannot set up companies. All right. So you can set up company, you can incorporate company and use it as a practice and operate your business, because beside your professional liability risk that you face, there are other risks that you face, right? You deal with landlord, and then you have some tenancy kind of issues that may also be a risk, business risk with landlord. You also buy things from supplier, drugs companies, and also, so there are also risks that you deal with suppliers. You have employees, right? So you may have employment issues. Those are also risks, right? Not necessarily a medical professional risk, right? Or you have patient come to your clinic and have a fall. It's not due to medical professional like negligence. Maybe your floor is wet or whatever, or your tiles that you use is slippery and then the patient fall. So those are not covered under professional liability risk, right? So that's why you need a company sometimes to manage it in the sense so that you can isolate your risk in the form of a company rather than as a sole proprietor or as a partner where you are personally liable for all such risks, right? Okay, certainly for private limited company, they are paying a lower tax rate. As you can see, currently the corporate tax rate is 17%. And on top of that, if you are aware, for the first $200,000 of chargeable income, there are certain exemptions, right? So before you get even to the 17% corporate tax rate, you have already an exemption from the first 200,000, right? So if you are a 3-year-old or less company, the exemption can be 125,000. That means out of 200,000, 125,000 is exempted. And then if you are 4-year and older company, the first 200,000, 102,500 is exempted from tax, and it is a significant tax saving because for every 100,000, 17% of tax, so you actually enjoy $17,000 of tax savings. So corporate tax, corporate entity does give you that kind of advantage beside having a 17% flat tax rate. As you're aware, for personal income tax, the highest tax rate for personal income tax is 24%. So you can see the gap there, right? 24 highest for personal tax, corporate tax highest is 17%. So there's a gap of 7%. Right? Later I will show you example. The difference that in terms of the corporate entity and a personal income tax. Doctor paying personal income tax, doctors having a private limited, and the corporate tax they are paying. is so much lower, right? All right. So as I mentioned, as a company, there are a lot of advantage you get through the exemption scheme, which I've mentioned to you at first 200,000, and on top of that, certain year you get tax rebates. Right, so like now we are filing the YA 2024 income tax. That means whatever you earn in 2023 financial year 2023, and you are filing your YA 2024 income tax, you get a 50%, all right, tax rebate, or cap at 40,000. All right, so it's very generous, right? For YA 2024, you actually can save up to $40,000 of taxes if you are a private limited. And you don't enjoy that if you are sole proprietorship. You don't enjoy that if you are partnership, right? Personal income tax, we do have a rebate, but it's only $200. Very miserable as a company enjoying $40,000 for this particular year assessment 2024, right? So you can see really a big gap in terms of the benefit. And on top of that, for those who pay tax below $2,000, right, there's also a tax cash grant of $2,000. So for companies are making losses, and if they have employed at least one local employee that pays CPF, they get a cash grant of 2,000. Again, this 2,000 doesn't go to a sole proprietor. It doesn't go to a partner in a partnership. So for corporate company, there are a lot of advantages. All right. So the other thing that a company, as a company, you can do is that you set up multiple company but doing only one business. But as an individual, sole proprietor, you can't do that, right? You cannot split yourself into three to run a business. But for company, you can, right? You can set up company A, company B, company C. All right. So later we'll look at some case study, right? How people pick up into three businesses, or they can, because of the exemption, first 3 year exemption I mentioned earlier, you can save up to $125,000 for the first 200,000. Every 3 year you set up one company, and every 3 year you close one and you open one, right? So you can do that. The law, I would say, in terms of Company Act, they allow you to open and close, but income tax is telling you can't because of tax avoidance, right? So the other one that IRAS are looking at is how you pay yourself. As I mentioned earlier, they see medical doctors as providing personal service, and therefore they expect that the doctor, when they set up a company, that the company should remunerate the doctors fairly, and not under declare and give the doctor only a nominal salary, right? So we will look at two cases, like I mentioned, have been went to the board of review and also to the High Court, and how you can see how they manipulated how they pay themselves. That's why I was very concerned, the way you are paying yourself, right? So for IRAS, it's definitely something that they are looking at seriously. That's why they have issued this tax guide to look at the corporate structure or the business structure of medical doctors. Okay, so we look at the spectrum: tax planning, tax avoidance, and tax evasion, right? Tax planning is legitimate, right? Based on existing law, you can take advantage of whatever the law gives you, all right? So for example, for tax planning, so as you're aware, as a taxpayer, individual taxpayer, you can actually top up your parents' CPF account of up to $8,000. And this $8,000 will go into your relief as part of the income tax relief, and then therefore it reduces your chargeable income, and therefore in turn reduces the tax that you pay. It can be very significant, $8,000. If you are in the top tax bracket of like those 22%, 23%, 24%. So it's just a lot, right? Top up yourself, top up your parents. So like this example, Alan, he used to be giving the mother a monthly allowance, all right, giving her a certain amount of money every month. So instead of giving cash to the mother every month, he can actually go and top up the mother's CPF account as a form of CPF top up. and get a CPF top-up relief. Especially if the mother is above 55 and have satisfied the minimum retirement sum. It's basically she can draw out the money, right? You're above 55, and if your basic sum, retirement sum have been satisfied, you can actually draw out the money from the CPF account. So instead of giving her cash allowance every month, you give it through the CPF top-up, and she can withdraw the money every month and use it, and on top, and you yourself enjoy a relief, a CPF top-up relief on your income tax. Right. So this way you can then enjoy relief through using this CPF top-up scheme. Right. So this is legitimate, this tax planning, right? Because it's given, right? The law allows you to do so. So you won't be penalized, right? In whether you're avoidance or I mean, not to the extreme that you're being evading tax. So as you can see, tax planning is okay, right? You conform to the law. Tax avoidance, a bit gray. They will look at your structure, whether what you are doing really do it for commercial reason, or you do it in order to save tax, right? That will not be allowed under Section 33, right? The worst case scenario is evasion, right? Which I don't see for medical doctors doing that. So evasion is one thing, where you purposely, with an intention, with a scheme to not pay tax. That means, for example, for evasion would be you report whatever people pay you through credit cards or PayNow and so on, but all the cash transaction, you don't record into your POS system. You keep it in the drawer and then you don't declare. Right? Those are evasion. Right? Some years back, I have a case of actually it's a doctor that does that and was charged in court, go to jail for 6 months. Right? The doctor did not report the cash portion of the revenue, only report whatever that is paid by credit card and so on. Right? The cash portion is always off the record. Right? Went to jail 6 months and okay, for a bit a technical part here is just briefly touch on 33, like I say, just to give you an inkling of what Section 33 is all about. It's basically talks about tax avoidance. It's a very big topic now. Like I say, IRAS is looking at all kind of business structure and setup, right? So to fall under Section 33, basically is that you have a certain structure or certain arrangement. May not be a business structure. It can be just a business transaction that you have. Maybe in certain terms they say you instead of direct buy sell, you want to go through many parties so that you can everyone along the way pay less tax because of the exemption scheme and all that. So in that way, you can get caught under Section 33 and be considered tax avoidance, right? So it's important to look at what you are doing. Important to look at whether your intention initially what you are doing are not for tax purposes, but for commercial reasons, right? Okay. So like I mentioned earlier, Section 33 basically tells you that even though you may satisfy certain conditions in Section 33, but if you can prove that whatever you do is not for tax purposes, but for other reasons, then you can get a waiver under 33(7). Right? And whatever you are doing is basically supported by commercial reason. Okay, here I just want to pause a bit. See, intention is sidetrack a bit. I mean, not really the topic we are talking about. Is to share with you. See, a lot of the intention sometimes is through thinking, or sometimes you have your business partner or director sit together, and then you all talk, and then you crystallize certain things that you want to do. All right. But it is important once these are done that you must have a process where all these discussions are put in writing, so that it supports your so-called intention later on. that you need to go to fight a tax case, particularly because intention it's just in your mind, right? But if you don't put it in writing, then later on when you go to court, how are you going to prove it? Right. So I'll give you an example. Like let's say I have a client set up a company for investment purposes, buy a property. Main purpose is for appreciation of the property value, and at the same time also enjoy rental income. Right. But subsequently, sometimes the property owner when they see certain opportunity, where the property price goes up, they wanted to sell within a short period of time. So IRAS will come after you and say, hey, no, you didn't hold your property long enough, and therefore they may want you to pay tax on it instead of treat it as a capital transaction. All right. So how to go about then proving to IRAS that my intention back then 2 years ago was to buy for investment and for rental purposes. So what is important is then 2 years ago when you buy a property, it's important either you do it in a form of a resolution if you're a private limited company, or if even individual, you can write it down. So private limited is good because you have resolution. So you can actually in the resolution, instead of just sometimes when we buy and sell property, our resolution very short. That's authorize you to buy. But it's good sometimes to have a lengthy resolution to put down so that in the future you can use it to support that you are doing it for investment. So you may give yourself some background first in the resolution. Why are you buying the property? So you must state in the resolution to say the board of directors have considered certain options to use the funds of the company to invest in immovable property, and then to for appreciations of value and to earn passive income from rental income, and therefore the board agree or approve to purchase the property. So if you have done that, if 2 or 3 years later when you sell it and IRAS come after you and say you are basically trading, you didn't hold it long enough, so at least you can have proof to show that, hey, back then 2-3 years ago when I bought this property, I have an intention to buy it for investment purposes. So you need to document it, right? So don't just go away thinking that it's very simple, just property. I just pass a simple resolution, director approve, that's it. I have to put it in writing. Similarly, sometimes when you set up a private limited company, you have to do a bit more, write up in your resolution to show what you are trying to do. Because a lot of cases they say, I want to expand my business and so on. That's why I have a private limited, because private limited allow you to, transfer, sell your share or transfer your share, and therefore you can grow or increase your share and then increase capital and then grow your business and so on. So all this must be put into writing. Right, so that's why when tax avoidance comes, then you can prove that I have done back then. That was the intention of the setup. All right. So when IRAS comes and look at your case, so they will then look at like I say basically a few steps. Whether what was the intention, right? Is it to take advantage of the income tax, or is it really for commercial reason? And then while you may have a certain intention, then they also want to look at now, right? After 3 years, 4 years, did that intention materialize, or is just talk only, right? So step must be taken, right? When you plan to do something earlier on, you must carry it out, right? So in this case, Dr. Bob set up a sole proprietorship, and subsequently he incorporated private limited. So the intention, if you look at this example, is that you have been operating as sole proprietorship all the years, 10 over years. Why is there a need for you now to convert to a private limited? What was your reason for doing so? Right. So you must then explain, right, why after operating 10 years as a sole proprietor, what is the reason for you to then move and convert into a private limited, right? So that's why this type of situation will put you into a tax avoidance situation, because unless you can give very good reason for doing so, Otherwise, the main thing will then come out that you are taking advantage of corporate structure, a corporate company where you enjoy lower tax rate, you enjoy the exemptions and so on, right? So I will go through this real case back in 2020. Dr. Wee, all right, well, a dentist. So initially when he started, Dr. Wee started, okay, just want to share some info here. You see, in normal cases, when you disagree with IRAS, I just want to explain the appeal process, so that an idea how some cases go up to High Court, and some cases at the Income Tax Board of Review. So in general, most of the time is IRAS come and audit you and raise some assessment, and you disagree with IRAS, you then object to the notice of assessment. All right, and then IRAS will then come back, refuse to amend the notice of assessment, and then after that, then you can file your appeal paper with the Income Tax Board of Review. All right, the Income Tax Board of Review basically chaired by 3%. Right, these 3% will sit. The chairman of the board can be a district judge, can be a retired judge, and normally there's also another academic person there, basically maybe from the universities or whatever. And sometimes then they will also have some maybe tax partner, people are in practice, or some tax lawyer with a very good qualification experience to look at your case. All right, so if Income Tax Board of Review come up with a judgment that you don't like, the next step is to go to the High Court. Okay, if you look at here, the name of the doctor appears in this case, right? You see, normally in the Income Tax Board of Review, the judgment is published publicly. But because it's an Income Tax Board of Review, they don't put your name. They will use some alphabet, XYZ versus Controller Income Tax. But if you go beyond the Income Tax Board of Review, when you go to the High Court, your name will be displayed. Like in this case, Dr. Wee, a dentist, actually went through the Income Tax Board of Review. He lost the case, and then he went to the High Court to appeal. And that's at this point, then his name will be publicly named in the judgment. I just want to share with you. Sometime later I'm going to share a case. It's only ABC, right? GIP versus Controller Income Tax. But in this case, you can see Dr. Wee Ting Yao's name is flashed here, right? So Dr. Wee started as an employee in this company called Dental Clinic, called ACOC in short. I think it's Dr. Alfred Ching, something like that. And he was, as an employee, paid 279,000 a year. And in particularly in 2012, he was paid 279,000 a year. He was so he received a salary, basically, he's an employee. Then in May, he decided to set up a private limited, right? And then he asked the employer, instead of paying him a salary of 279, or to that range, is to pay to his company, all right? And then in turn, from the company, his own company, he paid himself only 40,000 to about 110, over the few years. So some years he draw 40, some years he draw about 110 over this range. So as you can see, when he was an employee of ACOC, he has an annual income of around 200,000. But later when he corporatized himself, and then he paid himself less than half of what he used to pay himself. So very clearly, his conversion from an employee to a private limited have shown that it falls into those limbs of Section 33 tax avoidance, right? Because of the disparity in the salary. It's like today, 22nd of November, you get 200,000 a year, and tomorrow, because you set up a private limited, your salary dropped to 40 to or up to only half of 100 over 1,000. So this is definitely, you know, according to the court, even High Court say that, you know, you really forced into this tax avoidance kind of situation. All right. So it's important how you uh, uh, from from employee, and then you set up in you become your own boss. Nothing much change. You operate in the same place, or even if you don't operate in the same place, but you're doing the same thing. Suddenly your salary drop, right? Yeah. So whatever you do must have a commercial reason, like I say, you must crystallize it, and then have it written down and supported, and not only just writing, as I say, and then later on you must carry out whatever you plan to do, right? You cannot say, I write a very beautiful business plan, but it never happened, right? 5 years, 10 years, you're still doing the same thing, right? So whatever business plan you have put up, make sure it happens, right? So IRAS will come and look at, ask you why you need to set up a company, what's the purpose, and then how you pay yourself, right? Yeah, you remunerate yourself. So you have certain good reason, commercial reason, like I mentioned, have it written down and have it implemented also, right? Don't just talk and no action, right? Then nothing happens. Okay, so important when we put forth our reason for setting up a company. Medical professional risk is not a good reason, because the High Court case, and later I share with you the Income Tax Board of Review case, they do say that have same judgment, is that professional risk should not be the reason for doing so, because professional risk is normally tied to the person and not tied to the company, right? As a medical doctor, this is how the professional indemnity insurance works. Like you have but you can talk about other risks, like I mentioned, right? Risk with your landlord, risk with your supplier, even risk with your drug supplier or other kind of supplier, or you risk with your patient, not so much of the medical side of it, but other things, you fall down, get injured in your clinic and things like that, but not the medical professional risk. That cannot be a reason, like I mentioned in the Income Tax Board review, and also in the High Court. They say because medical insurance really tied to you as a doctor, the private limited cannot save you from that. All right, so they will look at the tax exemption rules and what was the intention of certain rules that you have. Like I mentioned just now, the tax exemption, the exemption first to 100,000, basically to encourage Singaporeans to set up companies and so on. All right. So you must have bona fide commercial reason for doing so. All right. So if you say I'm going to invest it, make sure it happens. Okay. So like I mentioned, IRAS view is looking at medical doctor providing personal service. So basically, to IRAS is the individual that's doing a bulk of the work, right? You don't have machines like in manufacturing and things like that. Basically, a lot of the work are done by you, right, as a specialist and so on. So that's why they lock it in that you provide the services, right? And therefore, when you have a company, the company should pay you based on your skill, your expertise, and your experience and so on. Okay, so it's important. Beside, like I say, the normal reason that you have, you must have very good reason to support whatever you are doing. Okay, splitting income. Later I'll share you some examples. In that means, instead of one setup, you can multiple setup. Right? You can, or sometimes you have sharing of staff, sharing of equipment, sharing of business premises. I mean, with team one clinic, there are two practices inside. right? Because you want to share the place, right? Because medical clinic are very expensive rental, so sometimes you need to share cost. So you have to be very careful when you do that, right? So anything that is artificial arrangement that are not supported by any commercial reason, IRAS will come down and look at it very carefully. And if they find that you are doing it not so much for any operational reason, business reason, then it will deem it as tax avoidance, right? Like this example they give, which I don't really see it. That means because of the tax exemption scheme that I mentioned to you just now, first 200,000, you actually first 3 years you have 125,000 exemption. So they're thinking that there are businesses that every 3 years they close and open, close and open. But so far I've not seen one. I'm not too sure why they talk about this. Because not easy to start a company and then close it. Because you have your clientele, you have a supplier and so on. They will get confused. And then if you are doing some kind of branding loyalty, you're going to lose it, right? Every time you change name, change setup. So I don't see this very often. At least for me, I have not seen it in the past 20, 30 years. No one have really do this. 3 years close, 3 years open a new one. Okay, so this is the example that IRAS give lah. So every 3 year, Dr. Tim was close company and then start another new company. It's not common. Okay, the other area that IRAS are concerned also is because a lot of the time, small businesses, family owned, sometimes they get their relatives, their spouse, children to work in the company. So IRAS are also looking at this type arrangement where you pay your related party like your spouse, your children, whether again whether they are market or benchmark. Right, so if you have children who have no work experience or just merely part-time come and help and you're paying 5,000-6,000 a month, then it can be questioned, right? Or they have a full-time job outside and then you claim that they come and part-time help you and you pay them 5,000 and their full-time job also 5,000. So full-time job 5,000 and then come and help you part-time also 5,000. So IRAS will then look at it, it doesn't make sense, right? He has a full-time job, pay him 5,000 and then come to your clinic, maybe during weekend or after work, you pay him also 5,000. So very important when you employ related person, you have to ensure that you don't pay them excessively. All right. As a private limited, sometimes we beside being a single director, you may have also appoint relatives, spouse, and so on as a director, and then you pay them a director fee. Again, cannot be excessive in terms of paying such a director fee. Okay. As we all know, company are separate legal entity. So companies and the owner of companies are viewed different as different entity. We don't see a company as an owner as a company, separate legal entity. So arm's length transaction, which great emphasis in this e-tax guide. IRAS have put a lot of emphasis on arm's length transaction. That when you're dealing with related party, you cannot pay excessively. All right. So what are the methods that I mentioned? Like if you employing your spouse or children, you can use some guide. MOM does have some guide, how to pay certain functions, certain roles. Right? But also take into account that whoever come and help you, your relatives, if they're not full time, then you don't use a full time pay to pay them. Okay, so we will then now look at some case study. These are extracted from the e-tax guide. So I'm sharing with you. So in this case, you can see this is John. Dr. John have one company that he have, because it's anesthetist, So he go around to different hospitals to do work, and then his hospital will pay him, right? So after in 3 years as a sole practice, sole proprietor, he set up a company in 2021. Nothing changed. Everything that he had been doing in 2018 and 2019 up to 2021 is the same. It's just that in 2021 he started up a company, right, to get paid. Everything is the same, right? Just that now he has a private limited, right? No employees, right? Minimal equipment, it's anesthetist, not much equipment that you have. Some may have a clinic, some may not have clinic. Some may have a clinic and shared by many anesthetists, all right? So he's the sole person that do the work, doing the work. He does the work himself, right? So can't rely on others to do the work for him. So in this kind of situation, which we have seen, so IRAS will disregard the private limited and say that you are actually operating or providing personal service, and therefore you pay tax as a individual income tax rate. Okay, this is different where we have other doctors have a physical clinic, see patient in the clinic, maybe do some minor surgery in the clinic. Those are okay, right? But for this, you can see, because he doesn't have a clinic, he basically move from one hospital to another, minimal equipment. So IRAS don't see this company as a functioning type of company where like say you have a physical clinic, patient come to your clinic or consultation, you do work there, you do surgery, or you basically work in the clinic, you are supported by nurses and so on. But in this case, doctor as an anesthetist is only doing it as a person, single person, right? So IRAS instead of situation will disregard the company and then tax him as an individual. Okay, this one very similar to just now Dr. Wee case, right? He's sole proprietor, then later he set a company. Also, there's a company that pays him. He was an employee, then the company pays him instead, and then now instead of paying him as an individual, as an employee, paid to a company, and then from the company, Dr. Lin draw a salary from the company. Right? So if you look at the dentist Dr. Wee case, because you can see that the way, after converting from a sole proprietor of employee into a private limited, the salary had dropped, right? So to IRAS, this kind of setup is also considered kind of a tax avoidance, right? Because the second company basically has no function, right? It's basically just to receive the doctor fee, right? Doesn't have a premises, only primary function is just to receive doctor fees and nothing else, right? Didn't own anything, no asset, nothing at all, right? Just receiving money only, right? Okay, so again, I share this very recent case, which is in May 2024, in this particular case. So this case, this doctor is a GP. He works as an employee of this medical group in 2011. Okay, so later, I talked to the employee, or the employer talked to him, and then they decided to form a partnership to operate a clinic. All right. So at the beginning, when he set up this partnership, the doctor joined the partnership as an individual, and then the medical group, which is a corporate entity, right? So you have this partnership with one hand, one is an individual doctor, one is a corporate entity. They form the partnership, right? In July 2011. He was paid monthly salary 12,000. It's a GP, right? And then a few months later, about 6-7 months later, the doctor looked at the structure and decided that instead of being an individual partner in a partnership, he incorporated a company, right? He incorporated a company of his own. So now you can see in the partnership, there are now two corporate entities, the doctor's company and the medical group, right? So this is the only structure that you will see here. All right, so now the 12,000 is still there, no change. But now the 12,000, instead of paying to the doctor as a salary, now the 12,000 is paid to the doctor company. And then in turn, the doctor pay himself 7,000. Again, you can see 12,000, because he set up the company, he drops his salary to 7,000. So this is, again, not very good kind of arrangement. I say you suddenly from 12,000 overnight, you know, your salary dropped to 7,000. So it's a very clear-cut tax avoidance arrangement, because your intention is setting all this company is nothing. Because whatever you're doing is still the same, right? You still do, you still work as a GP, you still work with your corporate partner, the medical group, nothing has changed. Every day you see patient, but instead of drawing 7,000, drawing 12,000, now you draw only 7,000, right? So in this case, it's what we call splitting of income, because you have three companies, and whatever you're doing is actually the same, right? One company is to collect consultation fee. One is to sell drugs, right? The other one is when you do surgery, you work with a hospital, you have another company. So this type of setup are also no, very clear cut. You're trying to spread your income over three companies to enjoy the tax exemption 3 times, right? So normal, if you have one company, you only enjoy 200,000. When you split into three companies, effectively you are enjoying 600,000, 200,000 times 3. So again, these are set up. It's not allowed by IRAS lah. So because this is again very clear cut tax avoidance cases, you split your income over 3 companies. Okay, so in this particular case, Dr. Eaton has his own company first, his own clinic. His clinic is run by himself, right? Subsequently, he found another location. He set up a clinic, and he also set up another company to run the clinic. But this time, he engaged a locum to run the clinic. Right? He didn't run both sides, right? So two clinic, two private limited, two separate clinic at different location. 2 doctors running the clinics, right? Dr. Eaton, but Dr. Eaton is the owner of the location. So he has 2 companies, 2 clinics. Each one independently run. Each one have its own premises, equipment, nurses, everything. All right, and then he pay himself according to what IRAS wanted him to do, arm's length, in one company, right? And then the locum doctor pay based on whatever market rate for GP. So in this type of setup, it is allowed, right? Because why? Even though it's still owned by Dr. Eaton, 2 companies, 2 clinics still owned by him, this is allowed because they are at two different locations, 2 sets of employee, 2 sets of equipment run by 2 different doctors, right? So this is allowed, right? Unlike earlier case, you split 3 companies at time, where same person, one Dr. Harry running 3 companies doing actually the same thing, just that one is for consultation, one is for drugs, one is for surgery. That one not allowed, right? So you can see the distinction here. Even though Dr. Eaton have 2 companies, right, but because it's the way it's set up, right, very distinct, two location. Okay, this one I've talked about it, so I will quickly run. Just now we talked about, you start one company, close one company, and then things like that, right? Okay, so all these tax avoidance cases, except for one, the main crux of the matter is this: you can set up how many companies you want. At the end of the day, you must pay yourself arm's length, right? You must not underpay yourself. So you look at the even two cases that went to High Court for review. It's because they dropped their pay, right? From 12,000 dropped to 7,000. From 200 over 1,000, 270,000 dropped to 40,000 or to 200,000. Those are not acceptable to IRAS, right? So you must pay yourself arm's length, reward yourself as per whatever your skills, expertise, and so on, right? Okay. So IRAS have given you two methods actually, right? One is the market rate lah, or the other one is what they call cost plus. Okay, so market salary benchmarking. So you find somewhere out there someone who are like you, with same area of specialization, expertise, same number of years of experience, doing the same work that you are doing. All right, and then you look at them. If they are paid a certain amount of money, then you must pay yourself that same money lah. So that is a bit tricky lah. How do you find that person? And if you have find the person, are they willing to tell you how much they're earning lah? So benchmarking is a very challenging method to use because we really don't have the kind of information, and IRAS is not sharing with us. You go to IRAS, you say, hey, no, I don't want to do the other method, cost plus. I want to use benchmarking. Can you share with me what is acceptable to you? IRAS tell you no, like you can find out what is acceptable, and then you then come to me. You then pay yourself that, and then if we audit you, then you have to prove to IRAS how you get to that amount of money, salary that you're paying yourself. So not easy, right? It's how to find that same person out there in the market. So generally, what IRAS want is to use this cost plus method, right? Cost plus method is come from the transfer pricing kind of methodology, right? If you are aware, it's also another big topic out there on transfer pricing when you're dealing with related party between companies and companies in the same group, subsidiaries, and so on. So they're also asking about, how do we pay each other, in the kind of situation. So there are various methods. Basically, there are 5 methods in transfer pricing. One of that is called cost plus method, right? So IRAS is saying, well, if you can't get a benchmarking salary for yourself, then you should use a cost plus method, right? So in the cost plus method, they take into account the operation of your business and your effort. Because like I say again, IRAS emphasis is you. You are the one doing all the work, and that's why they say that you should pay yourself substantially more, right? So they have 2 benchmark rates. Cost plus rates. One is 10% for specialists, 15% for dentists and GPs. Cost plus, that means 10% on the cost, not 10% of your revenue, right? So very important. So mix up the two, right? They are talking about 10% of cost. That means your cost of sales and your operating expenses, not sales, cost. Cost of sale, operating expenses. Okay, so I have this example here, Dr. Jin. Basically, let's say Dr. Jin has a revenue of 2 million, right, a year, and he paid himself 30,000 a month. So in a year, he paid himself 360,000. Okay, so on top of that, he had other costs. He got a clinic, pay rental. He got nurses. He pays salary to nurses, buy drugs, and buy have equipments and so on. So his total cost, including operating everything, is 800,000. So he actually made a profit about 1.2 million a year, right? 2 million sales, 800,000 total cost. So he make 1.2 million profit, right? And but he pay himself 360,000 a year, right? So in the cost plus method, what IRAS is saying, you can keep 10% of the profit in the company based on 10% of the cost, right? You can keep some money as profit in the company, and it is based on 10% of the cost. So you can keep $8,000 as profit. The rest, it should be your salary, right? So if you take, A minus B, which is your revenue minus cost of sale, 1.2 minus another 80,000, you should pay yourself 1.21 on top of the 360,000 that you have. So your total salary should be 1.48 a year, right? So based on this cost plus method, this is what IRAS want to see that you pay yourself. So you can see here, you only can retain about 80,000 as your profit. The rest should go to you, and you can declare as an employment income, right? So what is this cost plus method to you? Then how much more tax that you need to pay because of this cost plus method, right? So I will use this same case, Dr. Jim case, and show you the before and after. Right. So before that, Dr. Jin salary is only 360,000, right? So if let's say I make it simple, I don't put in all those reliefs and so on. I just do it simple illustration. So his pay is 306,000, and then his income tax payable is 53,000 a year, right? Personal tax. So for a company side, remember he 2 million revenue minus cost 800,000, his profit is 1.2 million. And then because of the exemption, remember just now we talked about the first 200,000 exemption, so his company been around for a while, so he has a lesser exemption, but still have about $102,000. So his chargeable income 1 over million, 17% tax, 186,000 from the corporate tax point of view. So for Dr. Jin, the total annual tax he pays from personal tax and his own company tax, 239,000. This is what he's been paying, right? In terms of his current setup, right? So what about if we use the cost plus method? Okay, so you can see here under the cost plus method, his salary is no longer 360,000. His salary is going to be 1.48 million. All right, so as you can see here, his salary of 1.48 million will then result in very high income tax, right? From 53,000 now become 314,000, right? From the personal tax part. But if I remember, while he pay a lot in the personal side, that means his company also pay lesser tax. So remember, company can only retain 10% of the cost, which is the 80,000. With the exemption of 42,000, he only pays 17% on the 300 and sorry, on the 37,500. So now he pays himself. Sorry, now he pays tax of about 600,000, and total tax now he pay is 320,000. Right. So as compared to before using cost plus method, additional tax that he paid every year going forward is 80,800 under this scenario. All right. So every year lah. So every year 80,000. Right. But remember, if you have been in practice very long, for the past year, actually you're also saving 80,000 a year. So you have been around it for 10 years. Actually, you have been saving 80,000. But just that now, if you put in this cost plus method, going forward, you need to pay additional 80,800 a year in this particular situation, right? So there is a jump from overall 200,000, you're paying about overall 301,000. So this is the impact. I just pause a bit here, let you absorb, so you can think about it, how this cost plus method will impact you going forward, right? So if you are unfortunate being picked up by IRAS for an audit, and then they come around and say, I issue a tax guide, did you follow the tax guide? I recommended two methods, benchmarking, cost plus method, which method have you used? And you have adopt a certain method, please explain why using this method. Right. So they may again, like I say, like ask you for information and so on. And I say certain thing you need to document it. Not just to refresh yourself, but to show proof that the intention of what you've been doing in the past, why you do what you're doing now, right? So it must be supported. So IRAS query can come in many forms. Many come in letter. They will send you a letter and ask you to provide information. Very, very rare they call you lah. IRAS officer don't call people. Most of the time we call them, we try to call them, but they won't initiate calls. But many by letters, right? After letters, what very common nowadays, they want to visit you. They may come and visit you, look at your clinic, look at your setup. Because sometimes in your response, you may tell them, I'm doing this. So they want to come and see. Right? They want to look at it. Whether what you say is true. Okay, so in the interview or in the letters that they send to you, they mainly ask you why lah. Like I say, that's why you need to have supporting document to explain why you set up a certain structure. Very important. All right. And okay, like I say, that some of you may have retained a lot of your profit in the company for future expansion, or for the acquisition of certain expensive equipment that you may have. All right, some of your specialization require you to buy expensive machines and so on. So sometimes you need to set aside certain amount of working capital to support the expansion or to support the purchase of a very expensive piece of equipment, right? Okay. So they will then evaluate whether whatever you explain really reasonable, like you said, I mentioned just now, the risk, contractual risk with tenants, supplier, employees, and so on. Okay, so after the review, right, depending on what's the outcome, if IRAS find that everything that you have been doing, everything's okay, then generally no further action. But if they find that whatever you're doing falls under either a avoidance case or evasion case, which is very serious, then IRAS may look at your case and then take certain course of action, right? And the worst one scenario, like I mentioned, the anesthesis, they may total disregard your company and then say there is a personal tax. Straight away, every dollar that you earn will be subject to personal tax. You don't even get to retain 10%, right? So if they think that you did adopt benchmark, you didn't adopt cost plus method, and they find that you have underdeclared due to this tax avoidance arrangement that you have, then you are subject to 50% surcharge on top of the shortfall that you pay. Worst case scenario, like I say, is those evasion cases. Okay, just to touch on GST, because sometimes you may say that, hey, why do I need a company since I'm going to do cost plus and all that? You may still want to have a company because of GST. Because if your fee income is above 1 million, you are required to register GST, right? So you don't want to register yourself for GST as an individual. It's better that you register yourself for GST as a company. Why I say so? Because if you register yourself as an individual for GST purposes, anything that you have as a business, let's say you own a shop house. That means beside your medical practice, you may have a shop house and be collecting rental from a coffee shop. The moment you register yourself as an individual, the rental that you collect will be subject to GST. Because once you register yourself as an individual for GST, all business related kind of transaction that you have will become a GST transaction, right? So that's why sometimes, even though you say I do a cost plus method, but I still need to retain the company because you have crossed the $1 million revenue, and therefore you are required to be GST registered. You still have to keep the company instead of registering yourself as a person as GST, because there are a lot of complications when you register yourself individual as a GST. Your other income that you have will get into the GST regime. So it's better to have a private limited. Don't get yourself involved in GST. Another potential risk that you face, right? So I quickly run through the frequently asked question. So again, like I say, IRAS always say that do not use reason like you set up company for the medical liability. They don't accept, even the court and all that won't accept that as a reason for doing so. So you have to be some other reason, commercial reason that to support your case, right? Don't again nominal salaries. Okay, so when you are new, not just GP actually even specialists. Let's say you leave a hospital and then you set up a company and start your own new clinic. You say, hey, I can't use cost plus method even, right? How do I even use benchmark? Also maybe cannot, because when I'm new, I don't even have the patient load to pay myself, right? So you ask me day one, I'm going to draw 1.2 million. Not possible, right? When I start, my patient load are very low. I need to build up my business. So it's fine. IRAS will not penalize you for not using cost plus or anything, or even benchmark, because as a new setup, your income is low, right? So and you need money to run your business, working capital, pay your staff, pay your nurses, and so on, right? So that is understandable, but like I say, cannot be too far off. Again, we will use the unplanned method, and then we'll work it out for you so that you're not too far off from whatever the unplanned transaction method. So new salary, okay. Yeah, sorry, new doctors, okay. You set up your own practice and so on, but cannot be too low also, right? So you must be able to show that your low salary, like I mentioned, because you're new, you don't start a new business day one, you earn 1 million or whatever. So you may need to adjust it accordingly over the years as and when you start making money, right? Okay, I must also highlight this fact that I want to need to retain money for future expansion. Again, it's not just talk. You need to make sure it happens, right? Otherwise, it will challenge you. And again, you cannot prove, then it claw back, right? 5 years, and the surcharge. The surcharge is a killer, 50%. All right. Okay, always this question. I do this setup because my accountant tells me so. My EHOI tells me so. Right. So IRAS again, the e-tax guy also mentioned this. While the professional can tell you whatever setup or structure that you have, at the end of the day, you are the one responsible to decide what course of action to take. So in the e-tax guide, IRAS have made it very clear, you are personally liable at the end of the day, because you are the one responsible. So you have to evaluate what is good, what can be done, what cannot be done. Do IRAS penalize tax agent for giving certain advice? Yes, there are cases. I have seen, at least if I'm not wrong, there were already two accountants being charged in court for collaborating with or collude, or you call it, with the client to evade tax. Charged in court, go to jail. Yeah, it happens. Okay, so section 33 is the one key thing in this e-tax guide, which I've explained to you and all that. And while you're under review by IRAS, you can continue to file your tax return as usual. And at the end of the review, then IRAS will then do all the adjustment for the case, right? So like I mentioned, sometimes you still need to retain your corporate structure, right? Especially if you hit more than $1 million, you need to be registered for GST. So you need to keep a private limited. For those fall below 1 million, whether you want to keep the company, don't want to keep the company, I think again you have to evaluate, your situation, whether is it you need to prepare to take some risk, business risk, like I say, risk with landlord, risk with supplier, risk with employees, and so on. right? So if you don't want to sell out a company, or you decide to convert it back to a sole proprietorship, then you no longer need to file the company income tax, right? So you can strike off, or in certain cases you may still keep your company, but then there's nothing much to report. You make losses because you only can retain certain amount of money, then you can ask for waiver. Okay, so just to summarize, so this is basically, again, like I say, setting out a company shouldn't be purely for tax purposes, right? It should be for commercial reasons for doing so. So IRAS will go through with you and review your reasons for doing so. And important is how you pay yourself lah. Before incorporation and after incorporation, right? From 12,000 you drop to 7,000. I think that is a no lah. Okay. I think I've come to the end. Any question? I don't see anyone type anything on the Q&A.